morning. Welcome to Trading Hour. I'm Reema Tendulkar. With me is Pavitra Parekh, and I've got Surbhi Upadhyay as well in the studio. And it's another quiet morning, right? I think every single day this week we've started off
with the exact same thing.
Exact same words, right? Yeah. Quiet, range bound. Well, today is another one of those days. The Nifty is hovering around 17,600. Let's see whether we can defend that Monday's low. That's a level of about 17,570 roughly. The Nifty went very close to that level, but from there, as you can see, it stabilized a tad bit. But right now, in the first 1.5 hours of trade, we've come off from the highs, but again, not by a whole lot. And the Nifty and the Sensex are trading absolutely flat. The mid-caps are outperforming to some extent. Asian markets are trading with mild cuts, so there is a bit of an underperformance that you are seeing in the Asian market screen. Today is the weekly options expiry, so watch out for that. In terms of the big movers on the way down, Divi's Laboratory comes in for some amount of profit taking. Eicher Motors too has had a pretty good run this month. It's up 10%. Today it's down 1.5%. Again, profits are being shaved off. Generally, pharma's on the back foot. Cipla, Dr. Reddy's under pressure. Reliance on Industries is subdued ahead of numbers next week. And IT continues to lose ground in trade. Yet another day, and HCL Tech is clearly nervous ahead of numbers post-market hours. HCL Tech is down close to about 0.5%. On the gaining side, not many big movers. Adani stocks are looking good. Adani Ports is up 1.7%, and Tata Motors is another big mover, and that's up 1.7%. You know, Pavitra, at a time when Tesla has missed earnings expectations, they've brought down their prices in China, because of which they've missed estimates. JLR coming out with their EV roadmap is quite the contrast, and I think that's one of the reasons that's fueling the optimism in Tata Motors and JLR today.
Oh, absolutely. And, we haven't seen all of the auto earnings start, but they start next week, right? So it'll be really interesting to see how they perform this time. That's from the auto pack. Reema has gone through the larger names, but, the action is really in some of the smaller names. Like we were pointing out, the mid-cap and small-cap index outperformance continues. It's why you're seeing the advanced decline also look quite positive right now, even when the market is a little bit in the red. So do watch out for that. In terms of the larger names, what's also not doing well in addition to pharma is something like Reliance once again under pressure over there, so I'd watch out for that. In terms of sectoral losers, it is the real estate pack also which is seeing some cuts today. Of course, you have Prestige, which is looking good on that brokerage call which came through. But other than that, whether you look at Godrej Properties, Oberoi, DLF, of course, this is after the stocks have run up a lot already. But that's what's happening in real estate. Looks like maybe the summer holiday season is picking up. We're seeing a lot of those stocks doing well, right? Some of the hotel names and stuff. So let's see, maybe we will be able to chat with some of the managements and tell you what's going on there as well. But Surbhi, like we were pointing out, on the surface it looks absolutely flat, but there is a lot going on underneath the surface. So take us through that action.
So to convince Reema that it's not really a quiet market, I've gotten up from my chair and I've moved to the wall, because absolutely, while the market continues to be range bound, I think a lot of the action has shifted to mid caps because the lower end of the trading range is not breaking. So there's a lot of accumulation going on beneath the surface. Even the mid cap index, if you look at the headline index today, it won't tell you the real story. It's in the stock. So let's talk about the buzzers. I've started off with some of the major volume movers of this morning. The one name that really stands out for me is Mirza International. Been watching the stock for the past 3 or 4 sessions. The reason that line's flat is because it's on a 10% circuit. The gains for Mirza International this week are 65%. Just explains the kind of accumulation that's going on in mid-cap and small-cap names. NMDC Steel is another one. That 13-14% move is on some pretty hefty volumes. Let's move on. A lot of the railway-related stocks are buzzing up and about today. Titagarh Wagons, big volumes on that stock today, 9-10% higher. Tex Rail, RVNL a little more muted, 2.5%. But I just checked up whether Ircon's up. Even Ircon is up about 2.5%. Concor also has some brokerage commentary. Even this one's up about 2%. So railway-related themes doing very well. And then it is consumer, and consumer. That's where the money is going in the mid-cap and small-cap arena. Whether you're looking at something like a Sula, which is up 3-4%, look at a lot of the innerwear stocks. All of them tend to move in a herd, and that's what's happening today. Lux is up 12%, Rupa is up 9-10%, Dollar Industries is up about 5%. Even a Shoppers Stop. As I said, anything consumer, and it seems that people have their eye on it. Shoppers is up 6.5%. A lot of the hotel stocks, as Pavitra was talking about, they're up and about. Look at Kamath Hotels, 6%, Lemon Tree, something quite small. Royal Orchid. Don't usually talk about this name. but it's participating in this consumer / hotel rally. Indigo Paints is a big mover on very good volumes today, 8.5% on the upside. So, just to put things in context, very clear, the shift in mid-cap and small cap, it's evident at the headline index level if you're looking at the monthly moves. In this month of April, the mid-cap index is up about 4%, the small cap index is up about 4.5%, the Nifty, in contrast, about 1.3%. Tells you where the money is and where the action is as well.
Rima, are you convinced it's not all that quiet?
I was talking about the index level. I was told that just focus on the index line because everything else you guys are going to talk about.
No, of course. And but that is the kind of move that we have seen in the mid and small cap space. Since we are talking about mid caps and we were talking about how IT overall is under pressure once more, there is one IT stock which is just zooming away, and that's Mastech. You want to tell us what's going on there?
What a solid set of numbers, right? And the thing is, it came completely out of surprise. Everyone is bracing themselves that, this quarter we're going to see muted numbers. If TCS, Infi disappoint, what hope is there for the rest of, the IT companies? So this came in as a big surprise. Look at those numbers. 5.3% constant currency quarter-on-quarter revenue growth. Year-on-year, it's approaching a 20% growth. And for comparison, Sher Khan was anticipating a sub 2% top-line growth. Compared to that, the company has delivered 5.3%. And this is largely organic, okay? It's not that it's getting a benefit of some acquisition. Margins, too, have improved by 50 basis points to 17.7%. And as I said, this comes in as a sharp contrast to what, up until now, very large pairs like Infi and TCS have disappointed. And just to refresh your memory, Infi, remember, had a revenue decline of more than 3%, and TCS's top-line growth was also very modest. So the point is, they're a very strong set of numbers, all organic, and it just came in as a big surprise. No one was anticipating, this kind of a growth number.
Oh, absolutely. And I think it came as a huge sigh of relief for the sector that people
all is not lost.
All is not lost, and people were, I think, really hoping to get some positive news. Now, no one's comparing a TCS Infosys with a Mastech. Absolutely different companies, different scale and size. But, at least this is one where business is on track, something's worked. We have more companies, as Science reporting. So I'm wondering, Rima, whether Mastech's performance will suddenly, spring hope for the rest of the mid-cap IT space as well.
Well, we'll come to that, but I just want to throw some more light on what Mastech has done, right? Now, Mastech, as you said, you can't compare it with Infi and TCS. They're far larger, diversified companies. But Mastech, per se, gets 60% of its revenues from UK and Europe, where traditionally it used to get more from the government and public service companies like NHS, that's the National Health Service in UK. They used to provide a lot of work to Mastech. But since then, it's diversified into the private sector. So UK and Europe is about 60% of the revenues, and that's doing very well. That had a growth of about 10%. The order book for the company, despite all the volatility, is up 5% on a quarter-on-quarter basis. They did some acquisitions last year, but despite that, the cash in the books is solid at 270 crore rupees, and plus their attrition is moderating. This is a trend across industries, but even for Mastech, the attrition number has come down to 21%, down 200 basis points. The only concern here would be US. Now, US, the company is trying to make inroads in US. They've hired a new leader there. But even this quarter, the top-line growth has been modest at 0.7% quarter-on-quarter. There is growth, but, compared to the company average growth of 5%, this number doesn't stand out. And the company in the conference call also spoke about slower decision-making in the US.
Okay, but you want to take us through some more of the comments that came through from the conference call, and what do the valuations look like? If I remember correctly, it is cheaper than some of its peers, right?
So the conference call yesterday was 5 p.m., so post-market hours, where the company said that the current margins of the company are about 17.8%, FY23. They're comfortable with margins at the current rate of about 18%, but their aspiration is to grow it to higher teens, which is closer to 18 to 19%, maybe even inch towards 20%. So that's the aspiration. But currently, they're comfortable with the margins that they have. And they also said that they will grow faster than the industry. And on the point about valuations, remember, most mid-cap IT companies are trading at very high valuation multiples. Without getting into specifics of each one, but broadly, you would say 20, 25x as well for some of them. Compared to that, Mastech is about 12 to 13, 14 times, right? Depending on, not too many people track it. So the estimates could vary, but 12, 13 times. So relatively, it's far more cheaper.
Oh, that's a very important point that you pointed out. I mean, that really explains a lot of this huge rush that we're seeing on the pricing, just because it has so much of valuation comfort. Okay, to come back to my point, because I'm clearly excited looking at this one number. So Cyan today, and obviously then there's HCL Tech tomorrow, and that'll take us back to Infi and TCS's problems and whether HCL Tech is better off. But what's the extrapolation, if any, that we can do into other earnings?
Well, difficult to do an extrapolation, but I'll just quickly run you through what we should watch. Cyient has given you an FY24 guidance as well. So not just FY23, they have said that in FY24, we will achieve $1 billion of revenue and an EPS of 60 rupees. They've even given us an EPS number. So do they maintain that in light of what we are seeing currently? In the case of HCL Tech, again, Q4, whatever be the numbers, that's, bygones, right? It's in the past. Focus will be on the guidance, and the expectation will be that the company will guide for a 5 to 7% growth, pretty similar to Infi's 4 to 7% growth. Not too far away from what Infi has guided. The question is again on margins. Remember, for Infi, the expectation was that the upper end of the margin guidance will be raised because the attrition is coming down, wage bill is coming down. But they didn't do that. What will HCL Tech do? Do they have the confidence to raise the margin guidance? I think that's going to be fairly critical. And just one more word on HCL Tech. The stock has already corrected. Since the beginning of the earnings season, the stock has fallen 5.5%, which is similar to what the decline in TCS has been. Basically, HCL Tech has already priced in a modest miss on expectations because these expectations were set prior to Infi and TCS. So if the miss is to the tune of TCS, which is a modest miss on both revenues and margins, I think it would be digested by the street, considering the stock has already fallen 5.5%. But if the miss is to the tune of Infi, right, a very large miss, then there could be some more correction, because Infi, for instance, since the beginning of the earnings season, has fallen close to about 13%.
And I think the word cancellations just does not go down well with the street. So as long as HCL Tech can avoid the word cancellations in terms of their Q4 and in terms of their outlook, I think the street will really heave a sigh of relief.
Oh, no, absolutely. Even what Mastech said in the conference call, UK is volatile, but it's still okay. The problem is US, and these companies get a larger percentage of their revenues from US. And Mastech said that they are seeing slower decision making, but they didn't say anything about project cancellations. And clearly, by the numbers, things are okay for Mastech.
Oh, absolutely. And the stock is at 13% right now at the high point of the day. So Mastech clearly doing very well and coming as, a big sigh of relief to a lot of these IT companies that everything is not over. It's not all bad after we got Infosys' results. But tomorrow we'll be back to big tech with HCL Tech, like we have been pointing out. That's everything that we're tracking from the tech space today. It is time for a short break on the show. But on the other side, we're going to shift focus from equities and talk about what's going on with commodities. We'll get you a quick check with Manisha. Welcome back. You're still tuned into Trading Hour. As flat as we can really get it for the markets right now. It's blinking red and green for the Nifty. It is the mid-cap and small-cap space where you are seeing all the action like we've been pointing out. The banks have corrected a little bit from the top, but, it is still holding up quite all right, around 90 points in the green. But let's talk about the world of commodities now. Manisha joins us. Manisha, you're going to tell us about that decline we've seen in crude prices overnight.
Oh, well, yes, and it has been to the tune of 2%, and with that, we are trading now at a two-week lows when it comes to the crude prices. So much so that the WTI crude is now trading below $80 a barrel. Well, so that is a bit of a breach on the technical charts, as you can say. On a weekly basis, we have seen 4% of decline for the crude prices, but on a monthly basis, we are still 12% on the higher side because the strength has been from $70 off a base to almost 79 is how we are trading on that one right now. Well, the street is now accepting the fact that the US Fed will deliver a 25 basis point rate hike in the month of May, and that may perhaps not be the end of it. You could be looking at another 25 basis point before this year ends. There also are rate hike expectations coming in from Bank of England, from ECB, at least 3 more before this year ends. And there has been a statement from RBA, that is the Reserve Bank of Australia, saying that the rate hike pause is temporary and there could be more rate hikes. And that's exactly what the street is getting jittery about. The bit of a strength in US dollar index also seems to be weighing on. And even as as the Chinese data has been better than street expectation, the muted economic growth numbers that we have seen come in from the US markets also seem to be weighing in. Also, the supply is not such a concern because we are looking at Russian exports highest since 2019, especially from the western ports, and that tells you that the supplies from Russia will continue even as they have been talking about cutting output. The markets also are looking at strong China demand numbers, at least for the month of March, and that is where we are seeing a reaction from. The US heating oil, when you look at the numbers there, is that the demand that is the lowest since 2022 January, and that's weighing onto the prices as well. So a bit of a contradicting fundamentals right now, but the street is still looking at the demand numbers, especially coming out from Europe and US, and that is weighing onto the prices right now.
Okay, got that. Thank you very much, Manisha, for all the latest from the crude oil markets. We do have to take a break on that note. As we do that, let's listen into some commentary that we got in from veteran investor Mark Mobius of Mobius Capital on emerging markets like India and China.
India is really a very exciting place to invest in emerging markets right now. But the good news also is that China is coming back. You were seeing the Chinese market now recovering. You know, China has underperformed and done very badly in the last few years. Now it's coming back. So people are getting more interested in emerging markets because China weighs so heavily in the emerging markets index. They're about 30% of the index. So I would say people have to look at China, most definitely India.
Welcome back. So the headline indices are not making any headway. Let's figure out what trading strategies that are there that you can perhaps look out for. We have Ashish Kayal joining in from Wave Strategy Advisors. Ashish, thank you for being with us. So I don't know, do you have any trades open on the index at all? And if you're not trading the index, then tell us about stocks.
See, if you look at the index, it's just moving in a range. On 17th of April, the index made a low of around 17,574. Which was on the result announcement of Infosys, post the result announcement of Infosys, and that level low is still protected, the high is also protected. So it's a no trading zone, to be very honest. Over here, possibly the option sellers can still make money, but the VIX is also low, the risk is high. So I would suggest that in case index breaks below 17,570 levels made on 17th April, then we can get a trend towards the 17,500 and where the open interest is very heavy. So a short-term sell call below 17,570, and on the upside, the major hurdle for index to cross is going to be around 17,700 levels as of now. And amidst this, the individual stocks are buzzing around. We can see the mid-cap stocks are outperforming, and overall, the first stock pick is going to be Lemon Tree. Long positions can be created here in Lemon Tree, keeping a stop loss of 83.20 for the target of 92.50. We have seen a very good breakout in this stock, and the target is at 92.50 for Lemon Tree. And the next stock on the buy side is going to be ICICI Prudential Life. We can see this sector is now buzzing over past few days. ICICI Pru has shown a smart recovery from the lower levels of around 390 and has touched 455 levels. More steam left here. So long positions can be created in ICICI Pru, keeping a stop loss of 441 for the target of 489.
Okay, thank you very much for that. By the way, IT is now seeing some buying at lower levels. So HCL Tech is now back in the green, having recovered more than 0.5% from the day's low. Watch for TCS, Tech Mahindra, Wipro, all of them are trying to inch up a tad bit. But let's get you some more stocks which are in the news. And this is on the back of brokerage commentary. Paytm is gaining in trade after Motilal Oswal initiated coverage on the stock. Abhishek joins in with the details. Abhishek.
Well, Rima, as you mentioned, Motilal Oswal has initiated coverage on Paytm. They have a buy recommendation and a target price of 865 per share. The report headline is Get Set Pay. So they say that, two-pronged strategy to drive profitability, and they expect EBITDA break-even to happen for Paytm by FY25. So payment business is posting healthy growth rate, and they estimate 21% CAGR on revenue front between FY FY23 to 25. They also expect disbursements to remain robust, and that will report a steady 64% CAGR between FY23 to 25. So this will drive the mix of financial revenue upwards towards the 31% level by FY25. They estimate contribution margin to improve to about 56.8% in FY25 from around 30% level in FY22. This will be fueled by the fact that there will be improvement in operating leverage as well as rise in financial business mix. So Paytm has achieved a break-even in adjusted EBITDA in Q3 FY23, which was well ahead of the guidance that they had given. So they expect Paytm to achieve an overall EBITDA break-even by FY25, and that is why the stock is up in trade today. Back to you.
Okay, all right, got that, Abhishek. Yeah, it is 2.5% higher, reacting positively to that report. Since we're talking about stocks reacting to reports, here's another one for you. Just pointed that out. Concor is part of that overall railway rally that's playing out. But the other kicker seems to be a report from Goldman Sachs. Goldman has actually upgraded this stock to a buy. Mangalam is joining in with more details. Mangalam, so what's Goldman saying?
Well, that's right. So Goldman Sachs has actually upgraded Container Corp from neutral to buy, and the target price that they have is 720 rupees. The biggest reason for them to do so is, according to their metrics, they believe that the stock is trading at a discount to the 10-year median valuations at which Container Corp has been trading. As per them, it's currently at around 22.5 times 2-year forward earnings. And if you compare that with the 10-year average that the stock has been trading at, is around 25 times. Apart from their thesis on Container Corp is no different from, what we've been talking about, or what a lot of the analysts have been talking about on Container Corp itself, the fact that the company will benefit because of its huge market share in the road to rail containerization traffic movement sort of thing, where Goldman Sachs believes that they are currently at an inflection point and their earnings could compound at the rate of 15.5% in the next couple of years. The other big trigger for Container Corp, irrespective of brokerage commentary right now, is privatization. So that's something we'll be watching out for as well. And in light of that, if a stock is available at a lower price or a lower valuation than its median valuation, then perhaps it is ripe for a rally, and that's what Goldman Sachs believes.
All right, Mangalam, thanks a lot for getting us all of the details from that note. Like Mangalam has pointed out, this stock has corrected almost 17-18% in this year itself. So perhaps Goldman now positive at these levels. But with that, we also have another brokerage note, and this is JP Morgan writing on the auto sector. Sonia is here with the details. Sonia, yet another brokerage house sounding quite positive.
Oh, absolutely. A lot of brokerages are now getting bullish on the auto sector, primarily because stock prices have become attractive, as well as demand has gotten resilient, and there's a pickup in demand across several spaces as well. Now, JP Morgan's top picks include TVS Motor, Bajaj Auto, and M&M. So these are their top 3 picks. Now, they speak about how rural demand is finally catching up compared to urban demand. The rural piece is coming back, albeit at a slower pace. They say that momentum is improving and the inventory levels remain healthy across several spaces. They talk about how the share of the top 10 cities continues to rise across passenger vehicles as well as the two-wheeler space. Now, remember, the two-wheeler space has not recovered compared to pre-COVID levels. Certain pockets are still struggling, like the mass market segment. But they do say that the momentum is improving and the inventory levels remain quite healthy. They also speak about how in the rural market, the tractor segment is picking up quite well. And hence, one of their top picks in that space is M&M. So overall, bullish view coming in from JP Morgan on the auto sector.
Thank you very much for that. That rounds up our brokerage corner. We'll get into a break. On the other side, we'll discuss market fundamentals. We'll invite Dheeraj Sachdev of Roha Asset Managers. Welcome back. Let's talk where the markets are headed from here on. The last couple of days have been spent in a very tight band despite a lot of news flow. We've seen the start of the earnings season. We've seen a few macro indicators as well come and go, but the markets have pretty much been unchanged. Dheeraj Sachdev, the managing partner and CIO at Roha Asset Managers, is now with us on the show. Dheeraj, are you convinced the worst of the price damage is now behind us and probably a bulk of the time correction is behind us and markets are primed for a move? And if yes, in which way, and what would be the big triggers to watch from here on?
Yeah, hi. So good morning. So to start with, we believe that macro issues of high inflation and consequent hike in interest rate appears to be peaking out. I mean, the whole of last year and since August 2021, we had issues of inflation, supply chain disruptions, high freight cost, etc., and then consequent rise in interest rates by central banks. These are all definitely getting reversed, which should support the Indian market going forward. Now, if one observes, March headline inflation has moderated to 5.6% after two consecutive above 6% readings. So core inflation too has surprised on the downside. And lower oil and commodity prices are a reflection of inflation trending down. So as such, we estimate a prolonged pause by RBI in financial year 24. Now, on the US economy, given resilient consumers and strong economic data, there is higher probability of the US economy facing only a soft landing versus a sudden crash or a deep recession. However, given slowdown stress in Western markets, we expect emerging markets to find favor. Now, emerging markets are under-owned and asset classes globally and have better growth, lower inflation, and less sovereign debt. So we expect a gradual flight of risk capital from slowing developed markets to relatively higher growth, stable currency emerging markets. And we expect India will be a favored destination for global investors to attract flows. Now, importantly, if you look at it, Indian economy is witnessing multiple levers of a secular growth cycle. I mean, these include private capex, government-backed PLI program, and sustainability of credit growth. I mean, these are all acting as triggers for the long term. So the credit growth for public sector banks, for example, at 15%, and for private banks at 20% reflect buoyancy in business and consumer lending. So India's domestic consumption will partly offset any adverse export market conditions due to global slowdown. So given this view, we do expect a comeback here of mid and small caps in specific that has underperformed over the last 12 to 15 months versus large cap index.
All right, Dheeraj, we got that point. But, if at a time like this, when the markets are expected to be so range-bound, when you're not expecting too much, at least on the index level, are there individual pockets or sectors where you think, it's perhaps still safe to put some money and expect decent returns? Are there any pockets like that which seem attractive to you now?
So plenty. I mean, our investment strategy obviously is more domestic-centric because export business is very much coupled with global economies. Hence, our portfolio focus is more domestic-centric businesses. Now, themes like banking, financial services, travel and tourism, engineering and manufacturing are interesting opportunities. We do like select pharma and specialty chemicals, which would come back as their profit or EBITDA margins are close to bottom. Maybe fourth quarter results will again reflect cost and margin challenges, but market may have already discounted it. And capital goods specifically, will be driven by capex cycle recovery, and we expect the execution of all cap goods companies and most EPC companies to remain healthy, led by strong order book accretion in the past 5 to 6 quarters.
Okay, Dheeraj, just trying to get your thoughts on consumption, because suddenly there seems to be a different narrative now in the market that rural demand is actually going to start picking up, inflation cooling off. And perhaps that's one reason why some of the two-wheeler stocks have started seeing some traction as well. A lot of the consumer names have started buzzing around. A, do you agree with this narrative and this theory that rural is going to pick up? And yes, if you are, then how would you play it?
Well, rural will take its own time, but given the election year for the next few months, we expect that there will be increased spending and consumption. The auto sector has so far seen a mixed set of numbers for the month of March. I mean, while two-wheelers and commercial vehicle volumes came ahead of expectations, tractor segment volumes were lower lower than our expectations. And demand for entry-level cars remained weak, though SUV is doing well. So we are more positive on the commercial vehicle side of the auto segment we have to play. Consumer durables is still seeing pricing pressure or the cost pressures. Though because of the onset of summers or very high heat wave, we are seeing air conditioning or air conditioners or refrigerator or fans demand to be strong. But they may actually see weak margins on account of higher cost and intense competition. So we are very selective, and we don't see too much of an earnings upside in most of the consumer durables or neither in the consumer staple businesses because of higher valuations.
Where do you stand on IT, Dheeraj? Based on what we've seen from large cap names like Infy and TCS, does this throw up an attractive buying opportunity right now? Or wait it out?
No, Rima, I think we need to still wait it out because see, the slowdown was sharper than expected. I mean, there was deterioration in demand from US with discretionary programs that were paused or cancelled. I mean, Infosys and TCS reported sequential decline in US market. And the revenue decline in North America was across verticals. So we believe that the IT sector will still take some time because of the demand uncertainty and could impact even in the June quarter or September quarter results possibly. So longer term, we all agree that the cloud-based applications and big data and IoT are interesting opportunities. But we think that the sector will underperform in the near to medium term due to growth and demand uncertainty in US.
All right. Dheeraj, just one final question. Do you feel like any of the new age companies are worth looking at now? We were just talking about Paytm a while ago as well. There's a brokerage note that has come out. Do you think any of them have seen valuations correct enough for you to be comfortable?
The valuations of new age companies have corrected, but while they are disruptive companies, many are still in the cash burn stage, and valuations, despite correction, are ahead of time and offer little margin of safety. So it is possible that some of the disruptive businesses can themselves get disrupted, and only a few will survive to make it big. So we will continue to be cautious, though we'll monitor progressively how the margins and the cash burn stage reduces. So yes, a couple of them can be interesting opportunities, but we are still too early in the game of new age tech companies.
It's still too early in the game. Dheeraj, thanks a lot for joining us with that quick chat. Very interesting to get your thoughts as always. With that, we are going to get into a short break. The market is still absolutely flat, but it has moved into the green around 10 points higher. The Nifty Bank is up a little bit right now, so around 140 points higher on the Nifty Bank. Let's take a short break, but when we come back, we're going to speak with Manish Gupta of CRISIL to discuss the telecom company's post-paid push. Stay tuned for that. Welcome back. You're still tuned into Trading Hour, and we're going to talk about the telecom space now. For that, we are joined by Manish Gupta, who's Senior Director at CRISIL, to help us understand more. Manish, thanks a lot for joining us. This is Pavitra. You know, a trend that we're seeing play out a lot in the telecom space now is the companies really targeting the postpaid segment, right? We saw that tariff rejig also come through. Can you take us through what's happening there? And more importantly, how do you expect this will translate into ARPUs? Because, I mean, I'm assuming there's already a hit coming through there.
So, first of all, thanks a lot for having me on the show. Before talking about postpaid and ARPUs, let me talk a little bit about the data consumption that is happening. As you're aware, data consumption in India has been growing very fast since the launch of 4G services in 2017. These services were then priced low due to competition and hence brought a massive surge in data consumption. Just to put things in perspective, the data consumption per subscriber per month has already quadrupled to around 20 gigabytes in the past 5 fiscals. Our expectation is this, that with the launch of 5G services, there will be a further fillip to data consumption. We are also seeing users upgrading to higher data packs, And also, telcos are offering free unlimited 5G data, along with that more over-the-top content. And there's a huge traction for online gaming as well. So with this, our call is that the data consumption in India is likely to grow to around 24 gigabytes in fiscal 24. That's the ongoing fiscal. And to around 28 to 30 gigabytes by next fiscal. And over the medium term also, we believe that it is going to continue to grow further as more and more 5G-led use cases unfold. Talking about ARPUs, our call on the blended ARPUs is that they're going to rise to around 205 to 210 in fiscal 24. This is up from around 175 that we estimate for the previous fiscal, that is fiscal 2023. Two reasons for this ARPU to go up. One, there is a upgrading to higher data plans that is happening. And second, there has been a revision in base prepaid tariffs as well. And this is the increase in the tariff for the non-internet users. And as a matter of fact, around 1/4 of Indian subscribers are still the ones that do not use internet. So there will be some increase over there. On the postpaid front, of course, there is a little bit of more competitiveness coming in, and hence there is a likely decline that we are seeing, or a moderation by around 6 to 8% in fiscal 24. So overall, that's our call on ARPU. Subscriber base also remains flattish, but it's still at a very high level at around 1.14 billion as we currently see.
Manish, just on the point of ARPU, I want to get to straight away the elephant in the room, right? Everyone's talking about when we'll get this big tariff hike, the meaningful one. While we've seen tweaks here and there on family plans, etc., from both Airtel and Jio, to what extent is pricing moving the needle in your ARPU estimates? Also, do tell us if you've got some market insights on what these changes in the family packs, if they've kind of meaningfully made any difference to some of the incumbents, and what is your outlook on a meaningful tariff hike? Yeah, so if you ask me, last year we have seen some broad-based tariff hikes that have already happened. In our estimation for ARPU increases, we are not baking in any major broad-based tariff hike on the prepaid side, and as a matter of fact, prepaid is something like 90% or more than 90% of the overall user base. So we don't expect any broad-based tariff hike. We are feeling that the data consumption is likely to go up. There will be more and more upgrading. That itself is going to drive the ARPUs. We're already seeing the telcos are trying to lure subscribers to higher data plans by offering the over-the-top services free of over-the-top services, plus 5G is being made available free of cost. So some of these things are likely to drive up the ARPU as we see in the coming fiscal. Till now, I think while the 5G rollouts have happened, but the 5G monetization is yet to begin. We expect that to happen only over the medium term and not immediately.
So when is your expectation of a prepaid tariff hike? Is it post-elections next year?
No. We are not baking in any major tariff hikes in fiscal 2024.
And that's both on the voice and the data side. I'm just asking, Manish, whether we could start seeing a divergent strategy because there's increased data consumption. Later this year, do you expect the companies to at all even try and capitalize on that, just in terms of moving the tariffs on the data part a little bit?
Yeah, so essentially, the 5G data is 5G services are being offered at the same tariff levels as the 4G. So we are not expecting any major tariff hikes to happen in the immediate run. Right now, the focus of telcos is to move people to more and more people to 5G side, and that is the clear focus that is coming out. The monetization of 5G may not immediately happen. So at least in fiscal 24, we are not baking it in our estimation.
Just to get some numbers that you are putting out, India is largely a prepaid market, right? More than 90% of the subscribers are on a prepaid model. But now increasingly you are seeing more postpaid subscribers. So postpaid as a percentage of the overall subscriber base will go up from the current 8% to 12%, right? That's your expectation. And on ARPUs, Postpaid ARPUs, which is the more expensive ones, because of the aggression seen recently by names like Reliance Jio, and Bharti too has followed it up, ARPUs in the postpaid segment are coming down. And according to you, they will further decline in FY24 by 6 to 8%. But on the prepaid side, despite no tariff increase, you are seeing tariffs go up because most companies like telcos are eliminating many of these entry-level plans. Correct? That's the picture right now. And going forward in FY24, what is the call on the prepaid tariffs? Currently, prepaid tariffs are at 170 rupees. There is not going to be a tariff hike. Can we still expect a further increase in the prepaid ARPU of 170 without a tariff hike?
Yeah, so I think let me just correct on one aspect that we are talking about 170 as the ARPU, not the tariff per se. So that's the average revenue per user per month. That's the level that where we are currently. We believe that there may not be any major hike in the prepaid tariffs, but the average revenue per user per month is likely to go up purely on account of higher uptrading and increases in the base tariff that was effected last year. So that itself is likely to drive up the ARPUs in this current fiscal. And our estimation is that the blended ARPU for postpaid and prepaid combined, that is likely to go up to around 205 to 210 in the current fiscal from the previous year's estimation of 175.
Okay, got that. Manish, another thing that, we were talking about is that the difference between the postpaid, prepaid seems to be narrowing, right? You have some estimates on that front as well. You want to take us through that?
Yes, I think you rightly said about the proportion of postpaid users. In India, because the gap between the postpaid ARPUs and prepaid ARPUs is coming down. I think if you look at a year ago, this gap was somewhere close to around 1.4 to 1.5 times. Now we are seeing it at around 1.1 to 1.2. So this gap itself is narrowed by around 50%, because of which we saw the proportion of postpaid subscribers to go up from 5% to 8% in fiscal 23. And over this base of 8%, we are expecting a further 4% fill-up, taking it to around a level of 12% in fiscal 24. If I compare this with the developed markets, this itself is very low. For instance, in US, the postpaid subscriber accounts for around 75% of total mobile subscribers. So this itself is quite low at 12% too.
Okay, got that. So perhaps more postpaid subscribers going ahead. No meaningful tariff hikes, but overall blended ARPUs is because of increased data usage moving to about 210. Those are the key takeaways, I guess. Thank you, Manish. Very helpful conversation. Thanks for joining in, and we look forward to discussing the sector with you again in the near future. We'll take a break on that note, and on the other side, we get you our special segment, Quarter Se Quarter Tak. The focus is on cement. Nigel joining in with all the dynamics. Welcome back. Okay, the other trend that's quite clear in the market is some profit taking in the pharma space, and that is still going on. So Divi's is down 3.5%, Dr. Reddy's is down about 1%, Sun Pharma, Cipla, a lot of these pharma stocks that have had a good run actually in the month of April, they're seeing some unwinding. So there's some profit taking in pharma, profit taking in Eicher Motors, some of the steel stocks. Remember, steel was a good space to be in yesterday, but again, metal prices have cooled off in China. And we are seeing, again, sentimental trade on the downside on some of the steel names as well. So those are the market trends. Index is absolutely flat, not much moving. The Bank Nifty is continuing its sort of movement, continuing to chug along. You've got HDFC Bank, Kotak Mahindra Bank. These are some of the banking names which are on the upside of the screen. So not bad over there. But let's move to some interesting commentary now. Homegrown, domestic-focused pharma and consumer health company Mankind Pharma is getting all set to hit the capital markets with an offer for sale worth 4,000 crore rupees. This is going to happen next week. Rajiv Juneja, VC and MD of Mankind Pharma, the company which is the manufacturer of brands such as Manforce, Prega News and Unwanted 72, talks to CNBC-TV18 about the interest seen in the roadshow and, of course, the growth drivers ahead.
We traveled 45 days, met every possible big foreign institute, domestic mutual funds, insurance people. So everywhere, I mean, they have really, I mean, welcomed us very, very warmly, and hope you people will also do the same thing.
In terms of your business, 97% sales come from the domestic market. Exports is just about 3 to 4%. You don't have much of a presence in, a mother market like the US. Is that going to be the growth trajectory going forward, domestic markets and a little presence in other markets such as the US?
Right from beginning, if you look at Mankind, we have always been very focused company. Always worked on our own strengths rather than on weaknesses. For example, if you go for export and we don't have some entry barrier in our products, some patents, some difficult to make products, some complex product. So for one or 2 years, we can have some profits. That would be all tactical. The philosophy of Mankind is always long term. And that's one reason only 3% export is there. So we don't really see ourselves much in export. We'll always be in India-centric. If you look at Mankind, we are a 27 years old company. We launched Delhi in 2004. We launched Mumbai side 20 years back. So we have slowly and gradually evolved. Philosophy of Mankind has always been not going and covering the market, going in a market and making a mark is our basically philosophy. So once we go in any place, whether it's a consumer side, look at our consumer division. Manforce condom, number one. Not only number one, it commands 30% market share. Look at Prega News, again number one, pregnancy cards for the ladies. Again, 80% market share, unwanted 72 emergency contraceptive pills. Sure. Again, 60% plus. Thought is always some kind of a leadership should be there.
Just on that point, consumer healthcare is probably another segment which a lot of people are interested in. It's only around 8 to 10% of your total sales. What is the kind of growth trajectory and investments that we can see in that space?
We are binded by this regulatory, so I'll just not go in any kind of speculation. But we see, I mean, we have look at the past. We've always grown very good in consumer side, and we hope to do the same in future. Let's hope like.
That's the big IPO, which opens up for subscription next week. The listing will only take place on 9th of May, but opens up in case any of the retail investors are interested. And their strategy is enter a market and then make their own mark. Well, out of time on Trading Hour from the entire team. Thank you for watching. We leave with the news that IT is trying to make a bit of a comeback.